Okay, what if you could look back at, say, 52 years of stock market history to find out which strategies actually work? Well, that's exactly what James O'Shaughnessy did in his huge study, What Works on Wall Street. So let's break down his findings and see what all that data really tells us about making money in the market. But first, you gotta ask, why is this even a question? I mean, we have armies of experts and endless analysis dedicated to investing. Yet, the vast majority of them, the pros, can't even beat a simple market index. So, what is going on here? And that brings us to what O'Shaughnessy calls the investor's paradox. It turns out the very people paid to beat the market, well, they usually don't. And the numbers behind this are kind of shocking. 80%. Just let that sink in for a second. 4 out of every 5 professional fund managers, with all their fancy degrees and research teams, fail to do better than a simple, unmanaged index fund. And this isn't just a fluke, bad year. The data shows this is a systemic, long-term problem. So if the experts can't win, what's the real problem? Well, the study points to a pretty surprising culprit. Turns out, the biggest obstacle to your investing success isn't the market. It's the wiring inside your own head. See, our brains are just hardwired for everything on the left side of the slide, the intuitive approach. We love a good story, we react emotionally to headlines, we get greedy, we get scared, we trust our gut. But decades of data prove that successful investing lives over on the right, a quantitative approach, built on discipline, history, and cold, hard rules. And these are the mental traps that derail us. We're overconfident, right? We all think we're smarter than the average person. We get hit with hindsight bias, where after a crash, we convince ourselves, oh yeah, I knew that was coming. And the big one, we chase the exciting story of a hot new stock while completely ignoring the boring but way more powerful statistics that are screaming at us to do the opposite. And hey, if you think you're immune to this stuff, just consider this quote from Sir Isaac Newton, literally one of the smartest people who ever lived. He lost an absolute fortune in a stock market bubble, getting swept up in the mania just like everybody else. It's the ultimate proof that raw intelligence is no defense against bad market psychology. So, if our intuition is the enemy, what's the solution? It's simple, really. We stop listening to our gut feelings and we start listening to what 52 years of pure market history has to tell us. We let the data speak. And the foundation for all these findings is the CompuStat database. Now, this isn't some small sample. This is 52 years of the most complete data you can get, covering booms, busts, recessions, you name it. This is the ultimate proving ground for any investment strategy you can think of. All right, now for the main event. After testing dozens and dozens of different strategies against all that data, a few key factors consistently rose to the top. They're what separate the long-term winners from the losers. And one metric, in particular, proved to be the most powerful of them all. But before we get to the big reveal, let's do a quick definition. The price-to-sales ratio, or PSR. It sounds complicated, but it's not. It just compares a company's total stock market value to its total annual sales. A low number means you're not paying much for each dollar of sales, which could mean the stock is a bargain. And it turns out the undisputed champion, the absolute king of all value factors for its sheer predictive power over 52 years, was the price-to-sales ratio. Why? Because sales are really hard to fudge with accounting tricks, unlike earnings. And the results? Well, they're just astonishing. Just look at this difference. It's insane. A simple strategy of just buying the cheapest stocks based on price to sales delivered a return of nearly 16% a year. On the flip side, buying the most expensive, popular, glamorous stocks, just over 1%. Compounded over 52 years, that's not a gap, that's the Grand Canyon of investing. And if those low returns didn't scare you away from glamour stocks, this should. The absolute worst-case scenario for a portfolio of those expensive stocks was a near total wipeout, a loss of over 93%. Buying into hype isn't just a bad strategy, it can be absolutely catastrophic for your money. Okay, so we have the data, we know what works, but the best strategy in the entire world is completely useless without the final and honestly the most crucial ingredient, having the discipline to actually stick with it, especially when it feels wrong. Let's look at a perfect case study of this from the book, A Strategy Called the Dogs of the Dow. It's super simple. Every year, you just buy the 10 highest dividend-yielding stocks in the Dow Jones. It has historically crushed the market, but its story is the perfect lesson in why investors fail. And the proof is right here in the numbers. Over almost 70 years, this disciplined strategy turned one single dollar into over $4,000. It beat the S&P 500's return by almost 5 times. There is no question, this strategy is a proven, long-term winner. But here's what happened in the real world. In the early 90s, the strategy was hot, the media loved it, and money poured in. But then, during the late 90s tech bubble, it started lagging behind all the hot tech stocks. The media declared it dead, and investors panicked and bailed out. Right before the tech bubble burst, and this so-called dead strategy came roaring back exactly like history suggested it would. People bought high and sold low, abandoning a winning strategy at the worst possible time. So it really all boils down to these 4 rules. 1. Use strategies, not emotional stories. 2. Let decades of history be your guide. 3. Invest consistently through the good times and the bad. And 4, maybe the hardest one, learn to tune out all that short-term noise and media hype. And that leaves us with one critical question to ask ourselves. Is your portfolio built on a solid foundation of data, or is it built on the shifting sands of market drama? Because according to 52 years of history, the answer to that question is going to determine your success.